up almost 20 odd points on the Nifty. The mid-cap index is flat with a bit of a positive bias.
While the market continues to be range-bound, I think a lot of the action has shifted to mid-caps.
The mid-cap index is up 23 points, so the mid-cap outperformance actually continues.
This is as quiet can be. 17,600 on the benchmark indices. The sensex is at 59,550.
We're virtually unmoved for the entire day. Not just the Nifty, but even the mid-cap index. I think both these two indices could actually end as flat, maybe without a single point move. So let's see how that goes. We'll get the average at around 332 odd. Stocks that were losing were some of the big gainers.
Well, as I said in that wrap, it was a pretty much flat day for the markets. Hello and welcome to Markets Today, the show where we highlight around 6 hours of the day's trading action in just 5 top headlines. I'm Michael D'Souza, getting straight to the headlines for the day. Market snaps its 3-day losing streak, ends the session flat. Financials remain on a strong footing. Nifty Bank outperforms the blue chips. HCL Tech reports its fourth quarter earnings. The stock rallied in early trade but closed flattish. Tata Motors gains over 1%. This is as it says that the JLR plans to invest £15 billion over the next 5 years to accelerate its EV strategy. JLR to launch its first all-electric Range Rover in 2025. Mastek surges more than 10% on the back of a strong showing in the fourth quarter, as its revenue growth outpaces larger peers like TCS and Infosys in constant currency terms. ICICI Securities, though, slips 4% as revenues decline quarterly in the fourth quarter. Paytm and Concur surge close to around 2% on the back of brokerage upgrades. JP Morgan bets on auto names like Bajaj Auto and Mahindra, among others. The stocks, well, they close with some gains in trade. Yeah, well, here's what we have lined up on the show for you. In market opinion, we have Dheeraj Agarwal of Ambit Capital and Gary Scholzberg of Wells Fargo Investment Institute. In corporate voices, we have Rajiv Guneja of Mankind Pharma, as well as Mr. Lakshmi Narayan of Tata Communications. Well, let's not delay. Let's get straight to the market action of the day. Dalal's straight, well, it ended its 3-day losing streak. A range-bound session, though. Nifty and the Sensex almost ended at the flat line. Financials remain on a strong footing, though, with the Nifty Bank outperforming other large-cap stocks. Surbhi Upadhyay joins us to run us through the day's trading action. Surbhi?
Well, it was another extremely range-bound session for the market, with the Nifty remaining in a very tight 100-point band. There's absolutely no clarity on the index in terms of direction, and that's playing out not just on the Nifty, on the Sensex, even on the mid-cap index for that matter. So if you look at the indices, then you would imagine there's nothing going on in the market, but of course that's not quite the thing. The action really is shifting to mid-caps and in a very big way, and I'll come to that in just a bit. But first, let me round up some of the trends that played out in the large-cap arena. Auto stocks, for instance, that's where the buyers were congregating today. So whether you're looking at a Bajaj Auto or Tata Motors, which made some announcements with respect to their EV plans, these were stocks that saw some buying. Maruti had some gains on it as well. IT has been very mixed ever since the big numbers came in. Today, TCS saw some incremental gains, but Infosys was again under pressure. HCL Tech a little nervous ahead of its numbers. So IT is quite muddled, and Pharma started seeing some profit taking. So trends are very unclear, and there's a lot of sector rotation that's going on in the large cap arena. Now let me come to mid cap, because here is where the traders have been really alive and kicking, to say the least. Look at the kind of gains coming in. And today, consumer was a big theme in the mid-cap market, whether you're looking at innerwear stocks or shoe stocks or hotel stocks or liquor stocks. And I'm just going to take some names as examples. Lux Industries, a Shoppers Stop, Indigo Paints, Liberty Shoes. We're talking gains between 6-7% all the way up to 20% in some cases. The other theme was railways, which was very, very alive and kicking, thriving really. So stocks like RVNL, Titagarh Wagons, Tex Rail, etc., they found some takers. So mid-caps are doing well. That's where the action is. The large caps in a range, with the Nifty holding at least the downside. We haven't seen a breach so far this week on that very important 17,570 level thereabouts. So let's see, one more day to go.
Okay, thanks a lot for that, Surbhi. Well, in market opinion, Gary Scholzberg of Wells Fargo Investment Institute believes that India can benefit if inflation stays within the target band. He also gave us his outlook on sectors to invest. Let's hear him out.
Well, I think the Indian markets have the benefit of inflation, the Reserve Bank moving to the sidelines, at least temporarily. And if inflation can stay within their target band, that really works in favor of India at a time when interest rates continue to move up, certainly in the developed country space. We continue to focus on the high quality, highly liquid stocks in the U.S. market. By sector, we continue to focus on the more defensive sectors, healthcare, energy to some extent because of the positive fundamentals there. We are preparing for a move into more economically oriented stocks, but we think it's really too early to make that move. For now, at least, as we enter a recession, the play in the stock market is to focus on these defensive sectors.
Well, let's get you some more market opinion. Dheeraj Agarwal of Ambit Capital is bullish on the FMCG sector. Let's hear out what he had to tell us.
The huge headwinds that we saw in a number of sectors last year in 2022 and parts of 21 in terms of margin headwinds, because the input costs were rising faster than companies' ability to pass on the price increases, is now reversing. A number of other consumer-facing sectors, including discretionary or FMCG, would see some margin boost in the next few quarters.
Moving to the second headline now, HCL Tech was buzzing ahead of its fourth quarter earnings. Remember, this has not been a good earnings cycle for major IT companies. We've had the likes of Infosys as well as TCS already reporting numbers. The IT index ended more or less flattish today. Rima joins us to tell us more. Rima, what is the street estimating from HCL Tech's numbers?
Thanks so much for that. So from HCL Tech, the expectation is that it could be a modest set of numbers, right? Infi, TCS have already reported numbers. The numbers have not been very good. So can HCL Tech be very different? So the expectations are fairly temperate. Dollar revenue growth of 0.2%, constant currency revenue decline of 1 to 1.5%. And the key reason for the decline is that last quarter, their products business, the software business, which is about 30% of their revenue, had a blowout quarter, very strong revenue growth. That can't sustain. So that, revenue growth in the products business will normalize, come down, and it will put pressure on their quarter-on-quarter numbers. Margins, according to our poll, are seen lower by 120 basis points, largely due to the decline in their products business, and this will put pressure on the company's bottom line, seen down close to about 5%. The key is going to be their FY24 guidance. Remember, Infi came out with a guidance of 4 to 7%. For HCL Tech, we're looking at a guidance of between 5 to 7%. This is for the overall numbers. Watch for the services business. And again, margin commentary is going to be very critical because the supply side situation is easing. So therefore, there is scope for the companies to improve their margins in FY24 versus FY23. But does it reflect in the margin guidance? That's something that the street will be tracking very closely. Remember, the stock has already fallen 5% from the beginning of the earnings season. So the street is anyway going into the numbers a bit subdued, expecting a bit of a modest quarter this time.
All right, thanks a lot for that, Rima. Well, moving to the third headline today. Tata Motors gained over 1.5% on news that its luxury car maker, Jaguar Land Rover, unveiled a 5-year plan to electrify its fleet. The company also plans to invest £15 billion over the next 5 years to accelerate the EV transition. JLR aims to launch its first all-electric Range Rover in 2025. Sanjay Suri filed this report.
JLR has spelled out its reimagined strategy for the next several years, and it's pointing the way of all electric, all luxury, very green, very clean. The company plans to invest £15 billion over the next 5 years in electric propulsion, with plans eventually to go carbon neutral by 2039. The Range Rover is due to go all electric pretty soon. The company is taking orders from as early as autumn this year for an all-electric Range Rover to go on the streets in 2025. The engine plant at Wolverhampton is switching to electric propulsion production, and JLR clearly is headed the way of sourcing battery packs and cells through the Tata plant due to be built in Europe. Sales from Britain alone have topped £12 billion a year currently and growing steadily. The company is planning to build on that in a luxurious sort of way. The company is sticking to the high end, none of those rough and ready Land Rovers of the old kind. By way of design, the company is headed the way of simple, clean lines, keeping it light, no crowded buttons. That matters for looks, of course, but it matters for battery life. JLR is working on a 700-kilometer range for the 2025 Range Rover with a 320-kilometer charge in 15 minutes. JLR clearly plans to lead the change in this fast-changing world of driving.
Well, moving on then, homegrown domestic-focused pharma and consumer health company Mankind Pharma is hitting the markets with a pure OFS worth around 4,000 crore rupees next week. Mr. Rajiv Guneja, the VC and MD of the company, says that exports have always been a small proportion of sales for the company and will continue to be an India-centric company. Let's hear him out.
We saw amazing kind of a interest. We traveled 45 days, met every possible big foreign institute, domestic mutual funds, insurance people. So everywhere, they have really, welcomed us very, very warmly, and hope you people will also do the same thing.
In terms of your business, 97% sales come from the domestic market. Exports is just about 3 to 4%. You don't have much of a presence in, a mother market like the US. Is that going to be the growth trajectory going forward, domestic markets and a little presence in in other markets such as the US?
Right from beginning, if you look at Mankind, we have always been very focused company. Always worked on our own strengths rather than on weaknesses. For example, if you go for export and we don't have some entry barrier in our products, some patents, some difficult to make products, some complex product. So for one or 2 years, we can have some profits. That would be all tactical. The philosophy of Mankind is always long term. And that's one reason only 3% export is there. So we don't really see ourselves much in export. We'll always be in India-centric. If you look at Mankind, we are 27 years old company. We launched Delhi in 2004. We launched Mumbai side 20 years back. So we have slowly and gradually evolved. Philosophy of Mankind has always been not going and covering the market, going in a market and making a mark is our basically philosophy. So once we go in any place, whether it's a consumer side, look at our consumer division. Manforce Condom, #1. Not only #1, it commands 30% market share. Look at Praga News, again #1, pregnancy cards for the ladies. Again, 80% market share, unwanted 72 emergency contraceptive pills. Sure. Again, 60% plus. Thought is always some kind of a leadership should be there.
Interesting one. Well, we'll wait by for that IPO that will hit the markets in the coming week. Well, time to slip into a short break. We'll be back in the jiffy with the other headlines that we're tracking for you. Don't go anywhere.
Yes. Quiet! It's okay for us to nod for everything, because we are parrots. But your wealth manager? Shouldn't be doing that. You know? No? Oh.
Choose Nuvama. We only do what's right for you and your money. Nuvama. Let's do it right.
Z-Black Premium Agarbatti and Dhoop, official prayer partner, Delhi Capitals.
We are all different, but our soul is the same. We go wherever life takes us. And we do it in our own way. Because it's our differences that make us who we are.
कैसे करते हैं ट्रेड? Try 5paisa. Powerful charts and research tool. One-click trade is the new cool. Get access to live market data. Margin funding bhi hai re beta. 5paisa app karo install. Trading made simple for all. With 5paisa's wide range of products. Yahan wahan chahe ho jahan. Simply trade on the go. Aise karte hain trade. Soch mat chote, install maar. Investment in securities market are subject to market risk. Read all related documents carefully before investing.
Welcome back. You're still with us on Markets Today. Well, let's run you through the remainder of the headlines as we promised you. Which brings us to the fourth headline. Mastek snapped, the bad run that we saw for the IT companies, posted a good set of numbers. The stock was up closer to around 10% in today's trading session. The company posts a 5.5% increase in constant currency revenue on a quarterly basis. Margins as well improved as compared to the previous quarter. Rima is back with us to run us through the key takeaways. Rima, a very good showing by Mastek, isn't it?
Well, it's just a strong performance all round. Very good execution. The company has been winning order wins, and their key market of UK and Europe is firing for them. So let me run you through the big numbers. A constant currency revenue growth of more than 5% quarter on quarter. Year on year, it's almost a 20% growth. And the quarter on quarter numbers are pure organic, right? So it's more than a 5% organic revenue growth. And compare this with expectations. Sharekhan, for instance, was penciling in a 1.8% revenue growth. So compared to street expectations, these numbers have blown the lights off. Margins too have improved by 50 basis points to 17.8%. UK and Europe, that's the key geography for Mastek, contribute 60% to the overall revenues, and that's seen a growth of more than 10% quarter on quarter. The order book has picked up sequentially by more than 5%. The cash on the books is 270 crore rupees, and the attrition is trending down at 21%. The management commentary in the conference call was also upbeat. They are planning to, the aspiration is to grow their margins to high teens. They've ended FY23 with margins of 17.8%, but when they mean by high teens and what their aspiration is, I think they're trying to get closer to that 18 to 19% band. They also said that they're quite confident about growing faster than the industry. So good Q4, and even the outlook by the company in terms of margins and revenues appears to be very promising, so that macro uncertainty, at least for now, doesn't appear to be impacting Mastek in terms of pure execution and delivery. Back to you.
All right. Thanks a lot for that, Rima. Well, in more earnings then, we have ICICI Securities. The stock was down close to 4% after reporting a weak set of numbers in the fourth quarter. The company reported a decline in revenues as well as margins as compared to the previous quarter. Surbhi Sutaria is with us to run us through a quick analysis on those numbers. Surbhi?
Thanks so much for that. So it was a weak set from ICICI Securities, but this was on expected lines as they were losing market share in their active client base for the last 10 months. Also, their trading volumes were lower on a year-on-year basis. On a sequential basis, their revenue was flat at 885 crores. Both their PBT and PAT were down 7%, mainly due to higher operating expenses and higher finance costs. When you look at their segmental data, their broking revenue was marginally higher by 4%. This was due to increase in retail derivative volumes. Their profitability was, however, lower by 3%. The issuer services segment, that has dragged down the revenues. There, the revenues were down about 74%, mainly due to decline in primary market activity, and the profitability was down 90% on a sequential basis. Now, we have two opposing views from brokerages. Citi has a sell rating with a target price of 440. They say that given in the volatility in the capital markets, the cost pressures are key monitorable. Also, they do appreciate the company's focus on diversifying its revenue profile, but the investment in these businesses is too high. The only silver lining, according to them, is the traction in distribution and wealth business. Motilal Oswal, on the other hand, has a buy rating on the stock with a target price of 530. They say their efforts to diversify their revenue and launch of new products will only enhance their revenue going forward. Company will continue to invest in human resources and technology, which could lead to a lower cost to income ratio in the future. They value the company at 12 times FY25 PE.
Thanks a lot for that, Surbhi. Well, moving on, Tata Communications recorded actually a weak set of numbers in the fourth quarter. However, the management is comfortable with the net debt as well as the EBITDA levels. Mr. Lakshmi Narayan of Tata Communications said that their priority is to have a sharp focus on cash generation. The stock was up close to 3% on the back of the positive management commentary. So let's hear out what he had to say.
And if you look at last 3 years, and you pointed that out, our debt has come down quite significantly. We are quite comfortable in terms of our net debt to EBITDA ratio. We have a strategy of a good cash generation within the company, and our first priority is to invest back into our products and platforms as we've been doing in the last year and going forward as well. And anything excess, we are going to be looking at debt reduction as a priority. We also just announced, for example, an M&A transaction with a company called Switch, which we hope to conclude soon.
Well, Reliance Industries is all set to report its fourth quarter numbers tomorrow. Sonia standing by to run us through the key expectations from the company. Sonia?
Well, it's a big day. Reliance Industries is all set to announce its Q4 earnings. Remember, the stock is down 7% in 2023 so far, but it's a decent quarter expected this time around. First, let me take you through all the key numbers that you can watch out for. On the revenue front, it's about an 8.5% growth that we're looking at compared to last quarter. While on the EBIT, the EBITDA could see a growth of around 5.2%. Margins could be a tad bit under pressure compared to what Reliance did last quarter. But on the profitability front, it's a 12% growth that we're looking at somewhere around 17,700 crores. Now, as I said, both the consumer as well as the commodity businesses for Reliance Industries have done decently well this time around. First, let's take a look at the oil to chemicals business, which is the key reason for the recovery this quarter. There's a sequential recovery that we're expecting for a couple of reasons. A stronger base gross refining margins and lower windfall tax is something that can aid this segment for them. In fact, looking at the gross refining margins, Singapore gross refining margins improved to $8.2 a barrel in Q4 compared to $6.3 a barrel last quarter. There's also a demand improvement seen because of the China reopening, and that has aided the numbers this time around. In the consumer-facing businesses, Reliance Jio has slowed down a tad bit, so we are seeing the revenue and the profitability growth moderate for them. In fact, it could be the lowest in the last 7 quarters. On the average revenue per user as well, it could be absolutely flat this time around at 178 rupees. A couple of reasons for the slowdown, but primary reason is that there's been an absence of a tariff hike, and that has caused Reliance to see a slowdown in its growth rate in the telecom business. Let's move to retail now. Retail growth is expected to be about 6% on a sequential basis, coming in at a little over 46,650 crores. These are the recommendations put out from Nomura. And on the EBIT side, we're expecting about 3,800 crores versus 3,600 crores last quarter on a sequential basis. So clearly, as you've seen, there's a decent growth expected. Some of the businesses like Rel Jio could see a bit of a slowdown, but it could be offset by good growth in the oil to chemical space.
Thanks a lot for that, Sonia. Well, we have the disclaimer that's flashing for you on the screen, so take note of that. Well, let's wind this down then with the fifth headline today. Paytm ended closer on 2% in the green after Motilal Oswal initiated coverage on the stock with a buy rating. Abhishek Kothari joins us with why the brokerage is betting big on the stock. Abhishek?
As you mentioned, Motilal Oswal has initiated coverage on Paytm, a buy recommendation and a target price of 865 per share. The key headline of the report is Get Set Pay. So they say that there is two-pronged strategy to drive the profitability of Paytm, and they expect EBITDA to break even in FY25 for the whole year. So Paytm's business posting healthy growth rate right now, and they estimate 21% CAGR in revenue between FY23 to FY25. They estimate disbursement to report a steady 64% CAGR between FY23 to 25, and thus that will drive the mix of financial revenue upwards to about 31% by FY25. They estimate contribution margin to improve to 56.8% in FY25 from the levels of 30% that they had reported in FY22. So this will be fueled by improvement in operating leverage as well as rise in financial business in the overall mix. So Paytm has achieved a break-even in adjusted EBITDA in Q3 FY23, well ahead of the guidance is what is stated in the report, and they say that they estimate Paytm to achieve an overall EBITDA break-even by FY25, and that is why the stock has gained in trade today. Back to you.
All right, thanks a lot for that, Abhishek. Well, meanwhile, Goldman Sachs has upgraded its rating for Concord from neutral to buy. The stock ended high with a gain of around 2%. Manglam Malu joins us to fill us in with details on that report. Manglam, what's exciting about the stock now?
Well, that's right. So Goldman Sachs has actually upgraded Container Corp from neutral to buy, and the target price that they have is 720 rupees. The biggest reason for them to do so is, according to their metrics, they believe that the stock is trading at a discount to the 10-year median valuations at which Container Corp has been trading. As per them, it's currently at around 22.5 times 2-year forward earnings. And if you compare that with the 10-year average that the stock has been trading at, is around 25 times. Apart from their thesis on Container Corp is no different from, what we've been talking about, or what a lot of the analysts have been talking about on Container Corp itself, the fact that the company will benefit because of its huge market share in the road-to-rail containerization traffic movement sort of thing, where Goldman Sachs believes that they are currently at an inflection point and their earnings could compound at the rate of 15.5% in the next couple of years. The other big trigger for Container Corp irrespective of, brokerage commentary right now is privatization. So that's something we'll be watching out for as well. And in light of that, if a stock is available at a lower price or a lower valuation than its median valuation, then perhaps it is ripe for a rally. And that's what Goldman Sachs believes.
Got that, Mangalam. Thanks a lot for that. Finally, JP Morgan is betting big on select auto stocks. This on the back of the pickup in rural demand and also improving momentum. Sonia is back with us to run us through details on that report. Sonia?
Oh, absolutely. A lot of brokerages are now getting bullish on the auto sector, primarily because stock prices have become attractive, as well as demand has gotten resilient, and there's a pickup in demand across several spaces as well. Now, JP Morgan's top picks include TVS Motor, Bajaj Auto, and M&M. So these are their top 3 picks. Now, they speak about how rural demand is finally catching up compared to urban demand. The rural piece is coming back, albeit at a slower pace. They say that momentum is improving and the inventory levels remain healthy across several spaces. They talk about how the share of the top 10 cities continues to rise across passenger vehicles as well as the two-wheeler space. Now, remember, the two-wheeler space has not recovered compared to pre-COVID levels. Certain pockets are still struggling, like the mass market segment, but they do say that the momentum is improving and the inventory levels remain quite healthy. They also speak about how in the rural market, the tractor segment is picking up quite well, and hence one of their top picks in that space is M&M. So overall, bullish view coming in from JP Morgan on the auto sector.
Okay, thanks for that, Sonia. Well, in what's its first of its kind meeting, the RBI has invited board of directors of private and public sector banks to a conference next month. Sources tell CNBC-TV18 that the RBI governor is likely to address governance issues, among others, at this meeting. Ritu Singh joins us to fill us in with what details she's picking up. Ritu, what is the significance of this meeting?
Well, thanks for that. It's very rare that you see entire boards of banks gathered together under one roof, and rarer still to have the Reserve Bank of India governor address them all directly. And so it's a significant development because we've been given to understand from sources that the Reserve Bank has invited the boards of directors of both public and private sector banks for 2 in-person day-long meetings, which are scheduled to be held first on the 22nd of May in New Delhi with select banks, and then on the 29th May in Mumbai with the other banks. Now, the agenda, which we reviewed, says that during these meetings, the Reserve Bank of India Governor Shaktikanta Das is going to address the boards on matters relating to governance issues, ethics, the role of boards and assurance functionalities of banks, as well as set the supervisory expectations as far as RBI is concerned. Now, the top brass of RBI is expected to be present for these meetings. So apart from the RBI governor, deputy governors and senior officials from RBI's Department of Regulation and Supervision are also expected to participate. Now, this comes in the backdrop of instances of governance issues which have come to light in some banks in the past, and the finance minister has also been giving repeated calls for improving governance levels in boards, especially when it comes to public sector banks. So let's see how this first-of-a-kind meeting transpires. But the bankers that we've been speaking to have welcomed this sort of consultative approach which is being followed by Governor Shaktikanta Das.
Thanks a lot for that, Ritu. Well, by the way, we have the numbers of HCL Tech that are flashing for you on the screen, and it looks like pretty much inline set of numbers, actually. On the profitability, it was looking a little bit better. But, if you just pull up the margin number, I think we were working with a number of closer around 18.4% or thereabouts. It's coming at around 18.2. The profitability is a little bit better, and I think the revenue number is almost in line with the poll, bang in line with the poll. So, those are the broad numbers that we have out there. Top line, bang in line. The EBITDA number is very, it's a miss of close to around 2% in comparison to our poll. That's what leads margins to come in at around 18.2% in comparison with around 18.4%. The profit number, it appears there is a bump up because, maybe something below the operating line. But those are the broad numbers. Rima will join us in just a bit to fill us in with more details on that. Remember, the street was bracing for a weak set of numbers. But how much of that bad news is already in the price? These numbers look pretty much in line. We're waiting for the guidance as well. But I think these numbers will go in as an inline set of numbers. Rima joins us as well. Rima, tell us, what's your first take on these numbers?
Well, still awaiting what the constant currency growth numbers are, but just purely based on the rupee revenue, the margin and the profit number, it's largely in line. There is a bit of a miss on the company's margins, but I think it would be digested by the street because after the TCS numbers, the stock has fallen. After TCS and Infi, the stock is anyway corrected by close to about 5 to 6%. which basically means that estimates have already been pared down.
Yeah.
So it needed to be a very big miss for the markets to be surprised on the downside, and just purely going, in the rupee revenue number and the margin and the profit number, the key is the margin performance, because on the top line, we typically look at the dollar revenue and the constant currency revenue growth. That is the more material revenue number rather than the rupee revenue. So out of the three numbers that we have, the key one is margins. And yes, margins have contracted by 140 basis points on a quarter-on-quarter basis. Correct. But we've seen both Infi and TCS miss on the margins, and that's because the top line has been missing. And the costs continue to remain sticky. So if your project gets deferred, you're not getting in the revenue that you were anticipating, but you have still staffed your employees on that project.
Right.
So that's the reason why companies have been missing the mark on the margin front. But, both Infi and TCS had missed margins by 50 basis points compared to expectations. HCL Tech has missed by 20 basis points. So I think purely, because that's the only number I'm going to be talking about right now, because compared to the other numbers, this is the more relevant one. I think it's a 20 basis points miss on margins, sharp margin contraction of about 140 basis points quarter on quarter. But I think it's something that the street would have braced itself for, that there is going to be a minor miss compared to expectations which were set prior to the commentary that we heard from Infi and TCS. The bottom line number looks a beat compared to, much better. And that's because the other income has gone up on a sequential basis. The other income is at 453 crore versus 260 crore.
All right. So, Reem, I'll give you a chance to further look into those numbers. For the time being, I think we're joined by the head of research at Reliance Securities, Mitul Shah. Hi, Mitul. Good evening. Thanks so much for joining in. I'm guessing that you also would have had a brief look at HCL Tech. Valuation-wise, it has some comfort out there. Going into these numbers, the stock has seen quite a sharp correction as well. Your view?
Yeah, hi, good evening, Nigel. Thanks for having me on CNBC. Yes, numbers seems to be more or less in line with estimate. Marginal miss, but as Rima pointed out, that the expectation after these two results were there would be a decent miss, but as compared to that, it is marginal miss, which can be considered as a key positive. Going more into the detail, what I am finding is that IT service business revenues have increased Q on Q. So impact is coming primarily from ERD business and this product business. So there is a seasonality impact always for the product business in Q4. So considering that, IT service is doing reasonably good compared to other two companies which reported their number. Even margin-wise, segmental margin, if I am analyzing briefly, then still numbers are quite good for IT service segment.
Okay, so these numbers would go down as an inline set of numbers, and from the pecking order, since it has valuation comfort, we'll have to wait by obviously to hear what the management has to say. But would you be a little bit positive on it?
Yes, compared to all these three results, this seems to be much better results, and as you pointed out, valuation-wise, we are quite comfortable for this company. Only the thing is that as both the management of TCS and Infosys pointed out some cancellation of deals and execution delays, so those type of cautious commentary certainly we would expect from HCL also, but we need to gauge what level of cautiousness these companies highlighting compared to other two previous companies. Based on that, we can estimate our valuation. But overall, within these three companies, valuation-wise, we are much comfortable on HCLT compared to. Deal win would be more important now, as and when we'll get that number. That will be important parameter to decide outlook for 24-25.
Okay, still awaiting what the guidance number is going to be by HCL Technology along with Infosys. Remember, HCL Tech also gives you a quantitative FY24 guidance. Infi had guided for a 4 to 7% growth. For HCL Tech as well, street expectations are between 5 to 7%. So a growth rate close to Infosys is what the street is anticipating. That's going to be the key number to track from here on, the guidance on revenues and the guidance on margins. Secondly, watch for the deal wins. Is there any slowdown that we are seeing? Okay, some numbers are coming in. We've got the guidance, and I think this is going to look like a good set of numbers based on the guidance. The revenue guidance is seen between 6 to 8% on a constant currency basis. 6 to 8%. This compares with 4 to 7% that Infosys had reported. Now, HCL Tech gets about 90% of its revenues from services business, which is directly comparable to Infy and TCS. They also get about 10 to 12% of their revenues from software or products, right? So this is where it's a little different. So the guidance that I'm giving you, 6 to 8%, is a good guidance in line with what the street was anticipating. Given the macro environment, 6 to 8% is the top line growth guidance. But for services, which is 90% of their revenues, the company is guiding for 6.5 to 8.5% revenue growth. And this will provide some comfort. I think the street was fearing that after Infy's guidance of 4 to 7%, maybe HCL Tech would also veer towards numbers closer to the bottom end. But a 6.5 to 8.5% growth is actually better than what Infosys is likely to report. So this guidance is not as bad as what the street would have feared. The second important number is the margin guidance. The margin guidance is a narrow 18 to 19%. It's not the 18 to 20% that the street was anticipating. So, once again, margin improvement that the street was hoping for in FY24 is not going to be very meaningful. In FY23, we don't have the actual number, but HCL Tech's margin should be closer to 18%, which means in FY24, margins will see a slight improvement, 18 to 19% margin guidance. Lots of numbers I'm throwing at you, but in a nutshell, HCL Tech's FY24 guidance is not as bad as what the street was fearing. It's actually closer to the upper end of the street expectations. 6 to 8% consolidated revenue growth. Services, which is 90% of their revenues, is going to see a growth of 6.5 to 8.5%, and margins are seen between 18 to 19%. So the upper end of the margin guidance band has not really been raised in the case of HCL Tech as well. But then when your revenues are still growing in mid-single digits, it's hard to get the operating leverage which is required to improve the margins meaningfully. Omkar Tangsale, the senior research analyst at ICICI Securities, is with us on the show. Omkar, how would you read HCL Tech's FY24 guidance, and how does it compare with what you were expecting?
Yeah, it's definitely, it is in line in the range that we were expecting. And, the first thing that, as compared to Infy, one thing should be considered, Infy is more on a conservative side, and they can, increase the guidance as, in the latter half of the year. But coming on to the HCL Tech again, it's still in the range. I believe 6 to 8 is just a 1 to 2% higher than the Infy's guidance range. So it's much in line in our expectations as of now.
Okay, so the guidance is in line with what you were anticipating. Mithul, would you want to comment on the guidance by HCL Tech?
I believe that guidance is reasonably strong. It is, in fact, slightly higher than the street expectation. After Infy's guidance of 4 to 7%, street expected it to be HCL also to be in the similar range or maybe slightly lower based on the past track record. But this is coming 6.5 to 8.5% for service business is really very big surprising. And very important point here in terms of employee addition compared to both the companies, where Infosys was a negative in terms of there was a net reduction in employees. TCS was marginal increase. Here, it is nearly 4,000 headcounts they have increased in fourth quarter compared to previous, which is higher than the Q3 as well as Q1. So there is a positive net employee addition to the tune of 4,000 is more encouraging in terms of their outlook and their confidence on the business execution for FY24.
Okay. So just some more numbers. Q4 is in line with street expectation. Constant currency revenue growth has declined by 1.2%. This is bang within the 1 to 1.5% decline that the CNBC-TV18 poll threw up. So revenues have fallen 1.2%, but in line with street expectations, and the decline in revenues is largely on account of the normalization of the products business. HCL, as I said, gets about 10 to 12% of their business from products.
Yes.
Right? That had a 30% growth last quarter, which is not normal. So that 30% growth had to come down. And that's the reason why quarter on quarter, the revenues were expected to come down. But their services business, which is directly comparable to Infi and TCS, and about 90% of their revenues, that has seen a growth of 0.6%. So they have not declined the way we saw in the case of Infosys.
Yes.
TCS had a 0.6% revenue growth. HCL Tech has seen a services revenue growth of 0.6%. But Infi had seen a decline. So the numbers are not as bad as what the picture threw up in the case of Infosys. Yes, these are still modest numbers.
Yeah.
But it's not as bad.
So, Rima, just to get a few highlights in there, the numbers appear pretty much in line. The guidance appears like more or less in line as well. No disappointment coming in there. It has some bit of valuation comfort because of the correction that we have seen as well. And post the recent correction, the street would have been fearing that if we had two misses, let's hope that we don't have a big miss out here. And that seems to be the case as well. So pretty good showing, I think, from HCL Tech, given everything, given the current scenario. It's not a blowout set of numbers, but, no big fear has come through. And no fear is good news, I think, right now.
No, absolutely. Even the dollar wins, the deal wins. Deal wins are tracking above $2 billion. It's at $2.07 billion. The average over the last 4 quarters is 2.2. So not too far off, right? You assume some delay in decision making, some slowdown in decision making, but it's still 2.07. So a little bit of a decline in deal wins, I think, is a given in a macro environment that we're in. So the decline in deal wins is in line, a little bit of a fall. Their hiring numbers are also encouraging because in the case of Infosys, we had seen headcount dropping. And that is seen as a gauge of demand slowing down. But in the case of HCL Tech, their headcount has gone up by 3,600 employees. And the pure fresher number is actually more than 4,000 employees. So the headcount too has gone up. And attrition, like we've seen in the case of other companies, has seen a sequential decline. But this is something that we were anticipating. So, as you pointed out, on the whole, it's not such a bad performance from HCL Technology. Q4 is in line with street expectations. FY24 revenue guidance is seen at 6 to 8% on the top line, with margins coming in at 18 to 19%. Their deal wins are largely steady, holding above $2 billion. Attrition has come down, and the company continues to hire. The net fresher addition stands at more than 4,000 freshers on a quarter-on-quarter basis. We thank Mitul, for joining in, and Omkar for taking his time out and sharing his insights. Gentlemen, thank you very much for that. We're going to wrap up on this edition of Markets Today. Thank you for watching.